Hello, smart investors, and welcome to another episode of Smart Real Estate by Westcliff, where we dive deep into the world of real estate investment to help you build a more secure financial future. I'm Adi Saeed, joined by my co host, Kaz Jaffer.
Today, we're kicking off our series by introducing you to the basics of real estate investment. We'll explore what real estate investment is, the benefits it offers, and why it should be part of your investment portfolio. Whether you're a seasoned investor or just starting out, understanding these fundamentals is crucial for making informed decisions.
So, there are four main benefits of real estate investing: cash flow, appreciation, tax advantages, and leverage. Let's dive into each one of them and ask Kaz some specific questions. Cash flow, which is the first one, is regular income from properties. Kaz, what can you tell us about cash flow?
Adi, cash flow is really, in real estate, typically involves owning rental properties such as industrial, residential, or commercial plazas. As an alternative, you can participate in the debt market without using your own leverage by investing in mortgage investment corporate funds, popularly called MICs. These allow investors to invest in a large group of mortgages and earn interest income from the pool of borrowers. Finally, in terms of structure, you can either own these units directly, invest with partners, or own them through an investment fund.
That's interesting. Can you give us an example of a cash flow investment?
Absolutely. For example, if you wanted to have some retail plaza investment exposure, you could purchase units in Smart Centers REIT, which allows you to be a very small owner of a very large pool of retail assets across the country.
That's great. So that was number one. Number two is appreciation. So increase in property value over time. How is this a benefit?
Well, Addy, as the saying goes in real estate, there are three things you need to worry about. These are location, location, and location. Appreciation refers to building a property with the intention of increasing its value over a period of time. This is also known as the classic buy and hold strategy.
During this hold period, are you doing anything to these properties?
Absolutely, Addy. In order to drive that value appreciation, part of that would be developing that in your investment thesis and your financial model, where a real estate investor would identify upfront what is that strategy to really drive this appreciation.
Are there different strategies that we could use to create appreciation in properties?
So there's actually four main strategies to drive value appreciation in real estate. The first is the one that we call value add. A value add strategy typically involves large renovations or building improvements where investors inject additional funds into the project in order to increase the income potential and value of the property. The second strategy is called change in use. For example, an investor may purchase farmland and change its use to residential. This process typically involves significant costs and a fairly lengthy government approval process. The third strategy is densification. For example, you could purchase a property that is zoned for single family, and you may turn this into a property with multiple units. And the final strategy is around development, where you take zoned land and you build a property on it.
So densification and development are quite similar, but at the same time, they're different. You're talking about building larger scale versus smaller scale. Am I right on that?
That's correct. So you may want to just maybe build one or two units, or do you want to do something larger than that?
All right. So that's two out of four benefits so far. So the last two benefits work in conjunction with cash flow and appreciation strategy that we mentioned above. Let's talk about tax advantages when investing in real estate. Kaz, can you give us some examples?
Absolutely. Nothing better than talking about tax on an investing podcast. There's a few advantages on tax, and for all of us, that's our biggest expense when we think about our overall cash flow. And the first advantage from a tax perspective is the ability to be able to receive cash flow from the property while your tax obligation is delayed until the sale of the property. A second advantage is really an opportunity to reclassify your income. If you were to hold your property in a corporation and choose to leave the profits from the property in the corporation, you'll now be able to reclassify your income instead of a dividend or income to a capital gain, which is taxed at a lower rate upon exit. Please note that this is more general information for our investors and our listeners. And if you're looking for professional tax advice, please discuss with your CPA or reach out to myself. As we mentioned before, I am a licensed CPA.
All right. Last but not least, leverage. I love this topic. So far, we've assumed that you've bought the above mentioned investments without using borrowed funds. However, you can juice up your returns if you borrow money to make an investment. Kaz, can we talk about this?
Sure, there's two main benefits when you employ leverage. And leverage for our listeners is really taking debt against the property. So finding a way to be able to buy the property without using your cash, but as they say, using other people's money, which could be a bank, a credit union, or another source of finance. The first way that you can use the leverage would be reduce your initial investment amount to help generate some return from a smaller investment. Let's say you're buying a $500,000 property all cash that'll generate $100,000 in profit. You're expected to make a 20% profit from this investment, 100 divided by 500. But if you're able to purchase the same property with only 50% loan proceeds, you'll be able to increase your profit by 50% by investing only 250,000 instead of the 500,000. This will allow you to generate more returns per dollar invested, even after you subtract the interest cost. A second method is borrowing the down payment for a property from maybe one of your existing properties and writing off that interest for tax purposes. This allows you to basically buy a property for 100% leverage and actually not pay any cash down.
Real estate investment offers a unique combination of cash flow, appreciation, leverage, and tax benefits, making it an attractive option for diversifying your investment portfolio. I want to thank all of my listeners for tuning in.
Smarties, if you found this episode helpful, don't forget to subscribe to our podcast on all the major platforms. Ready to take the next step in real estate investment? Please reach out to us at Westcliff Asset Management for personalized advice and strategies tailored to your needs. You can visit our website at www.westcliffam.com or give us a call or text at 647-799-2264. We're here to help you make your investment journey a success.
Please remember that this podcast is for informational and entertainment purposes only and does not constitute specific financial advice. Always seek professional advice before making any investment decisions.